Alrighty, we are going to a wonderful topic. Just a note, this is going to be critically important, not only here, but also for partnerships. This is something that I personally was confused on when I was taking the exam. That's why I kind of went to town, really making sure we explained it properly here in this exam here for you in this review course. So make sure you understand the differences here. This could be something you see on a sim, something you see on a sim comparing S-Corps to partnerships. Super important to know. And just a note as well, as I mentioned, this is something, just one of those topics where, because it's so similar to partnerships, we're going to really dive into it more so here and not as much in partnerships. So make sure you understand it here. We will have questions on it in partnerships. We will reference it in partnerships, but make sure you really pay attention to it right here. Now, pass-through loss limitations are going to be a critical aspect of S-Corps, as they are with every type of entity. But we have this extra layer of rules for S-Corps and partnerships. Since S-Corps are pass-through entities, shocker, not that you knew that already, profits and losses are passed through to shareholders and are going to be reported on their individual tax returns. However, these losses are subject to limitations based on the tax basis and the at-risk basis. Gotta love it. IRS is always trying to clamp down on our fun, being able to take these losses and deduct our taxable income. So first off, the tax basis. This is also going to be referred to as the cost basis, generally what you think of as your normal basis. So you can totally think of it like that. Generally, it's the original cost of an asset plus any improvements made, less any depreciation, losses, or return of capital distributions. That's more so dealing with actual physical assets. But for shareholders in an S-Corp or partnership, it is also including their initial investment plus any additional capital contributions. It's increased by their share of the entity's income, decreased by their share of the entity's losses and distributions. So as you see, it's pretty much the classic definition of any basis that we've seen. Basis you deal with for depreciation purposes, basis you deal with for your investment in an entity. Again, so that's your normal basis. Tax basis is used to determine the taxable gain or loss when the asset or ownership interest is sold. Now, the funky one is the at-risk basis. This is something where we're going to see. This is the probably, like, if you were familiar with either of these two, you'd be familiar with tax basis, or at least I hope you are by this point. We've seen it a good amount of times. But if not, no worries. The at-risk basis, however, this is going to be the amount of money that is at risk, what I like to call your skin in the game. So your tax basis, it's kind of like leverage. Think about it like leverage. And if that's a concept foreign to you as well, it's kind of borrowing money, it's doubling down. If I put $10,000 in the stock market, the most I could lose is $10,000. However, if I put $10,000 in the stock market and then leverage it with options, derivatives, financial instruments, I may be subject to lose more than $10,000. So it's kind of magnifying your gains and losses. So too, your at-risk basis includes the total amount that you could lose in this investment. So it not only includes your initial investment, but also anything else that, let's say, creditors could come after you for. We're going to see, especially with partnerships, because one big difference between S-Corps and partnerships is the liabilities. Obviously, it's a big component. That's why you create certain structures to begin with, as we've talked about many times, is what is your personal liability? Is it limited? Is it unlimited? So when it comes to partnerships, a lot of times, if you've got recourse liabilities and someone can come after you, and I know I'm still going to read this blob here for point 2, but I'm just going to beat this point to death. If I put $10,000 into my partnership, let's say, and then I'm also on the hook for $2,000 of recourse liabilities, and the partnership goes down, goes bankrupt, I not only lose let's assume everything is lost, there's no assets to be distributed. I not only lose my $10,000 of initial investment, but I also am on the hook for the $2,000 that I owe for those liabilities. So again, it's not just your initial investment plus gains minus losses, all that, like your tax basis. It also includes your full skin in the game, what you are personally liable for. So again, if you pledge that you are going to personally guarantee some loan that the entity is taking, that goes to your at-risk basis. That is something that you'll be on the hook for if the entity goes to hell, if everything goes down. Now I'm actually going to read the paragraph, and I'll give many examples because it's super important. Make sure you know it for all of these topics. Now, this is the amount of the taxpayer's own money or property that is actually at risk in the business. The at-risk rules are generally intended to limit the amount of loss that a taxpayer can claim to the amount that the taxpayer could actually stand to lose. The at-risk basis starts with the same initial investment as the tax basis. So generally speaking, we will see the at-risk basis be the same or higher than the tax basis. We can see it be lower, but we'll see many examples and run through them. So again, it's generally the same initial investment as the tax basis, but some increases or decreases may be treated differently depending on the nature of the income, loss, or distribution. So for example, borrowed amounts generally increase the tax basis, but they only increase the at-risk basis if the taxpayer is personally liable for the repayment. So if you're dealing with an S-Corp and the S-Corp assumes the liability and it goes bankrupt, you're not on the hook. It's fine. It's not going to increase your at-risk basis. The key difference here between the two basis calculations lies in their purpose and how they account for certain forms of financing. Tax basis primarily concerned with the cost of an asset for calculating gains or losses, whereas at-risk basis focuses on the amount of actual risk a taxpayer has in an investment, including financial exposure to borrowed amounts. First step is to understand the differences, and then we'll apply them. We'll see where they're relevant. We'll see where this all comes into play. All right, dealing with this more, we are focusing more so in the tax basis with an example. So the tax basis limitation for pass-through losses in an S-Corp states that a shareholder cannot deduct losses in excess of their tax basis in the corporation. This is just a loss limitation. The IRS doesn't want you taking losses in excess of what you initially invested. That would, for them, they're saying, hey, that's not fair. Tax basis is determined by the shareholder's initial capital contribution. Again, this is just your normal tax basis that you'd see on your K1, right? That you would just see as, if you're keeping calculations of your basis and questions that are asking you to calculate your basis, any capital contributions, any undistributed income from the S-Corp that has been taxed. If the pass-through loss exceeds the shareholder's tax basis, the excess loss is suspended and carried forward indefinitely to be used in future tax years. Additionally, any suspended losses cannot be deducted when the S-Corp is disposed of. So that's an important point to keep in mind. If the S-Corp is terminated, liquidated, it just shuts down, whatever that is, then those losses, boom, they're gone, poof, magic. Now, for example, if a shareholder has a tax basis of $50,000 in an S-Corp and the corporation reports a net loss of $70,000, and this is assuming it's 100% owned, the shareholder can only deduct $50,000 of the loss. The remaining $20,000 of the loss will be suspended and carried forward indefinitely for use in future tax years. Now we've got our at-risk basis. Let's see what we're dealing with here. We got an example as well. The at-risk limitation for pass-through losses in an S-Corp states that a shareholder cannot deduct losses in excess of their at-risk basis in the S-Corp. At-risk basis, again, is determined by your initial capital contribution. Any additional capital contributions, you could also call it your tax basis plus what we'll see personal liability for the S-Corp's debt. Non-recourse debt is not included because non-recourse debt, and just a note, you don't have this memorized by now, non-recourse debt, you're not personally on the hook for. Recourse debt, you are. So non-recourse debt is not included here. If the pass-through loss exceeds the shareholder's at-risk basis, the excess loss is suspended and carried forward indefinitely to be used in future tax years. So for example here, if a shareholder has an at-risk basis of $100,000 in an S corporation and the corporation reports a net loss of $120,000, but $20,000 of the debt is non-recourse debt, the shareholder can only deduct $100,000 of the loss. The remaining $20,000 of the loss will be suspended and carried forward indefinitely for use in future tax years. Now here, we're talking a little bit more about this, wrapping it up before we see some examples. If the S corporation is disposed of, any suspended losses can be used to offset the gain from selling the stock. It's your last chance to use any suspended losses, otherwise, poof, they're gone forever. This means that any suspended losses can be used to reduce the amount of taxable gain that the shareholder realizes upon the sale of their stock. Now, you realize something, but then you could have other items that affect the realized amount, which is then what you'll recognize. If you've got a $10,000 realized gain, now this applies pretty much anywhere in the exam, but then you've got some sort of deduction, be it from a credit or from a suspended loss or whatever, for $3,000, your recognized gain now is only $7,000. So again, that is super important for SIMs, for multiple choice questions, for everything from individual tax to all of our different entity types. You've got realized and then recognized. Now, realized is what really happened, and then recognized is what you record on your tax return, which takes into account all of the arbitrary, and I say arbitrary, but it could be logical as well, different components, credits, deductions, additions, anything that the IRS imposes, through their different various rules. Now, in conclusion here, pass-through loss limitations for S corporations are subject to both tax basis and at-risk limitations. Losses that exceed the tax basis or at-risk basis are suspended and carried forward indefinitely to be used in future tax years. Additionally, any suspended losses cannot be deducted when the S-Corp is disposed of, but can be used to offset gains from selling the stock in the S-Corp. All right, first example here. Let's run through a bunch. Let's have a great time while doing it. ABC Corporation is an S Corp with two shareholders. We've got John and Jane. They each own 50% of the company. The company has a net loss of $100,000 for the year, which is split equally between both of them. So they have $50,000 each. John has a tax basis of $70,000, while Jane has a tax basis of $50,000. The company also has $20,000 of non-recourse debt, and John has an at-risk basis of $90,000, while Jane has an at-risk basis of $70,000. There we go. Tax basis limitation. Well, John can deduct his entire $50,000 share of the loss as it's within his tax basis of $70,000. Similarly, Jane can deduct her entire $50,000 share of the loss because it's within her tax basis of $50,000 as well. However, then we have kind of like check number 2. Then we're going to check the at-risk limitation. John's total at-risk basis is $70,000 after considering the non-recourse debt. Therefore, he can still deduct the entire $50,000 share of the loss as it's within his at-risk basis. And similarly, Jane's total at-risk basis is $50,000 after considering the non-recourse debt. So she can deduct the entire $50,000 as it's within her at-risk basis. Awesome, awesome. Powering through. All right. Kind of continuing on a similar path, but we got a couple changes, a couple other points. ABC Corp, we've got the S Corp, two shareholders, 50-50. Net loss of $100,000 for the year, divided equally. One shares of the loss is $50,000. John has a tax basis of $70,000, while Jane has a tax basis of $50,000. The company also has $20,000 of non-recourse debt. John has an at-risk basis of $90,000, while Jane has an at-risk basis of $70,000. Let's talk about the loss in excess of the at-risk basis is suspended, carried forward indefinitely. Since John's share of the loss, $50,000, is less than his at-risk basis, John can claim the entire $50,000 loss. The same applies to Jane, who can claim her entire $50,000 share of the loss, as it's within her at-risk basis, as we saw on the previous slide. Neither of them has an excess loss, so no loss is suspended, but this is just reiterating the point. Check for that. If we did have a loss in excess, we would carry it forward indefinitely until you sell the stock or it's disposed of or the company goes under. It can be used to offset gain from selling stock of when it's disposed of. In the future, if either John or Jane has suspended losses and the S-Corp is disposed of, any suspended losses can be used to offset the gain from selling the stock. However, in this scenario, no losses have been suspended. Now, in summary, we got to check for both of these basis, the tax basis and at-risk limitations. Losses that exceed the tax basis and at-risk basis are suspended and carried forward indefinitely to be used in future tax years. Any of these suspended losses can be used to offset gains from selling stock when the S-Corp is eventually disposed of. Keeping this on your mind at all times, you never know where it's going to pop up. You're doing great. You're doing wonderful. We're powering through to the next one.
Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.